The caveat about borrowing money is that eventually you have to pay it back. But a loan is not the only type of liability a company incurs. There are several other instances in which businesses end up owing individuals or institutions, from paying employees for services rendered to paying taxes. All of these come under the heading of liabilities.
Liabilities arise when we obligate ourselves to transfer economic resources to another party at some specified future date. So all that a liability is an obligation to transfer economic resources at some future date. And in the interval, we pay for using the money they've advanced to us or the resource they've advanced to us. We know exactly how much we're going to have to pay back. We know exactly when it's due, and we know exactly who we're going to pay it to.
Who to pay, when to pay, how much to pay. These known or certain liabilities include accounts payable, sales taxes, unearned revenues, and payroll. Accounts payable are related to daily purchases of products and services on credit, which are usually paid for within 30 days. Businesses that collect sales taxes must record them as liabilities, which are eventually paid to local and state governmental agencies. We must be careful to separate sales taxes from the related sales revenue. For example, a retail business sells $500 of merchandise to a customer to which a 7% sales tax applies. Notice that the tax is separated from the sales revenue. Unearned revenues represent cash received from customers before the business delivers goods and services. For example, a publisher might receive cash for annual subscriptions to a magazine. The magazine issues have not yet been published and sent to the subscribers. A liability must be recorded. Employee payroll involves a number of considerations, but basically we must record how much employees have earned, what will be deducted from their pay, and what additional payroll liabilities are owed by the business. The total amount of employee wages and salaries earned is an expense. From this amount, deductions are usually made for Social Security and Medicare taxes, federal and perhaps state income taxes, and voluntary deductions for savings plans, union dues, and so forth. The remaining amount, or take-home pay, is the net amount owed to employees. Employers bear additional payroll tax expenses, including Social Security and Medicare and state and federal unemployment taxes. These taxes are owed and eventually paid to governmental agencies. All of these liabilities to employees, taxing agencies, and others must be paid and paid on time. Exactly who to pay, when to pay, and how much to pay on a liability is not always known. Even so, estimates should be made and recorded on a timely basis, which, among other things, addresses the need to match expenses with revenues for the period. Warranties and additional employment expenses are typical examples. Companies sell products and services that often come with implied or expressed warranties. Automobiles may be warranted to be free of defects for 3 years or 36,000 miles, whichever comes first. The warranty expense must be recorded as the cars are sold. This requires an estimate, which is based on past experience and engineering calculations. The expense and estimated liability are recorded in the period of the sales. Later on, the liability is reduced as warranty claims are met. Some companies provide post-retirement health and pension benefits to employees. The right to these post-retirement benefits is earned by employees as they work for the employer. So an estimate of this liability for future payments must be made and recorded, along with the accompanying expense for the period. Making these estimates is very complex and makes use of actuarial science. An estimated liability with its related expense is also recorded as employees earn the right to take paid vacation time. The liability is reduced as employees take their vacations. Contingent liabilities are somewhat similar to estimated liabilities, but they're a bit trickier to account for.
There are a whole range of contingencies. For example, a hurricane is a contingency several times in the fall every year, late summer, early fall. Until the hurricane hits, there hasn't been an event take place. So the standard for booking or recognizing in the accounts a contingent liability is some event has happened. It is probable that we're going to have a loss. And probable, the accountants haven't used that word very well. Probable really means anything over 50%. If it's probably going to rain tomorrow, the chances are it's over 50%. Otherwise, it's improbable. But we generally use the word probable in assessing whether contingency should be recorded at a higher level, maybe 75 to 80%. But in any event, if the loss is probable, and if we can get an estimate of what the cost will be, then we make an entry for it, debit, loss, credit, or liability. If, on the other hand, this event has happened, but it's not probable yet, or we can't measure it, we will have a footnote that will describe the circumstances and merely indicate that we cannot make an assessment of the loss at the current time.
American Airlines, for example, faces a variety of contingencies.
In the airline industry, some of the unique things are frequent flyer obligations, environmental issues that may occur at airports that have to do with cleaning up airports as different environmental issues are raised. Of course, any type of litigation or any other contractual commitments that we may have as sort of a second party if a primary party fails to follow through on an obligation. All of those things could give rise to a contingent liability.
Whether known or estimated, liabilities are a company's obligations. Detailed information about a company's liabilities is important to many decision makers, whether internal or external, because liabilities represent claims against the company's resources. Recording liabilities accurately also helps ensure the proper matching of revenues and expenses.